First of all, I would like to thank Andre, Nuri, and Ryan for the invitation, and start by saying that this is a very preliminary work. It is such a preliminary work that there's no paper yet, and in lieu of the paper, we sent you the slides. And as Andre mentioned, Will, my co-author, is here. And if you have especially any simple clarification questions, then please do ask in the chat and will try to answer. But first of all, let me tell you why I'm really excited about this project. And I have to say that it's growing on me with every single day. It is an outgrowth of our project with Will on the valuation of unicorns. So that paper got a little bit of attention also from the media. And we generated some, let's say, critics in Silicon Valley because we claimed in that paper that the unicorns are vastly overvalued. But even though that paper was very exciting, we realized while working on that paper that there were some challenges in valuing venture capital-backed assets. And that is what we're going to do here. We will try to address some of the remaining major challenges and create a parsimonious model of venture capital valuation. And what actually happened as a result of that is that we uncovered some really interesting economic mechanisms and some results that I think are going to be surprising, were surprising to us. I think might be surprising to you, and I believe definitely will be surprising to practitioners. So we have not yet presented this to anybody in the industry, but we really look forward to that as well. But before I go into what we do, let me provide you some motivation. So first of all, venture capital assets used to be considered very unimportant, like a corner of the industry, of the financial market. It is no longer the case. What I show here is the US VC deal activity, and last year it reached $135+ billion. There were about 12,000 VC deals. If you look at the total VC fund capitalization in the US, now this is only the US VC funds. It excludes any non-VC participants such as SoftBank and others. Then it's about two-thirds of a trillion. And if you look at the reported values of all the venture capital-backed assets in the US, it's well above $1 trillion. So it is an important asset class these days. Another reason why it is becoming an important asset class is that there are a lot of non-traditional industry participants that are coming to this industry. And I can show you statistics as well, but I decided to go with just a very simple example. I went to PitchBook and I took the latest company I could find. And my only constraints were US and early stage. So the company I found is FalconX. It's founded 2 years ago. It's blockchain technology, not surprisingly. It's a very small company. It's 32 employees. It's located about 3 miles from where I'm presenting right now. And it's raised $17 million a week ago, 2 weeks ago. And it is this company's first VC round. And so far, nothing is surprising. It is a very, very standard early stage VC company. What is surprising, it comes next. If you look at the list of investors, there are traditional VC funds, but one of the investors is Fidelity Investments. That is, of course, a mutual fund. So what's happening these days is that mutual funds, such as Fidelity Investments, as well as other non-traditional investors, such as sovereign wealth funds, go and invest directly, and not only in Ubers or WeWork, but they invest in this case, the company that is raising its first venture capital round. And I checked with Fidelity Investments, and it has hundreds of investments like that. So this is another reason why it's really important to understand how to value venture capital assets. The problem that we're going to resolve in this, the problem that basically why we started this project, is how to value stakes in these companies. And there are several challenges, obviously. First, those are private companies. So you may not have access to companies' information. An example of an investor that has this problem is an LP limited partner in a venture capital fund partnership. And LPs typically have very, very vague information about portfolio companies. Even if you do have access to private company information, such as venture capital funds investing directly, it is still very difficult to predict company cash flows. And so it is very difficult to impossible really to use the DCF analysis, something that we teach our MBA students. And even if you can try to use that, then what turns out is that these companies have extremely complicated financial structures, and not only unicorns, but very, very early stage companies as well. So those are the problems that people who are trying to value these companies face. And generically, there are two ways. What I mean by that is both the companies, so venture capital-backed company, and also the securities that are part of, or the components of those companies. So there are two approaches, as I said. The first approach is you just take your securities and you mark them to the price of the most recent round. Now, intuitively, it does make sense for the following reasons. First, these companies raise multiple funding rounds. When I say multiple, that means a lot. Facebook, for example, raised 10 plus rounds. Uber raised 10 plus rounds. But also small VC companies VC-backed companies raise a lot of rounds. So on average, a typical VC-backed company, unless it fails right away, will raise 3 to 5 to 6 rounds, on average about every 15 months. And so there are basically a lot of rounds. The second is that sophisticated investors compete to offer financing, meaning that the round price is fair, that achieved in a competitive environment. And so it seems to make intuitive sense to use the most recent price. And indeed, this is used. This is used by almost uniformly by mutual funds, such as Fidelity, by a number of venture capital funds, according to our evidence, by some academics, by some LPs, and so on and so on. What is the problem here? Well, the problem with this approach is that each investment has different contractual terms. When I say each investment, I mean each investment in each funding round. So if Uber has 10 funding rounds, then each funding round will have different contractual terms. That makes it difficult to just mark the price of your security to the price that the most recent security raised achieved. And let me show you one example. And the example I chose is the company that everybody is talking these days, SpaceX. Some people are surprised when they find out that SpaceX is not a public company. It is a private company in the sense that it is not yet publicly traded, even though it was founded in, I think, 2005 or 2004. And so if you're a venture capitalist invested in company in 2005, you likely still have securities that are still illiquid. So what I'm going to show you the payoffs to SpaceX securities for three types of securities. Common, which is owned by the founder, by the employees mostly, and then by two venture capital investors, by Series A and Series B, and they own what is known as convertible preferred stock in the trade. So this is the typical VC security issued by US VC-backed portfolio companies. And on the X-axis, we have the potential exit value in millions of dollars, and on the Y-axis, I'm showing you the Series B per share payout in the mergers and acquisitions. And so what is going to happen here is that, and I'm going to move the slide. So what you will see is that effectively the payoffs of different securities differ quite a lot. And that is because their terms differ a lot. So Series B term was very different from Series A. It had some additional preferential terms. And both Series A and Series B had very preferential terms over common. As such, for the reasonable at the time exit values of the company, the allocation of payoffs would be very different to the security. And so in this case, it would be very difficult for Series A to say, Series B was issued and I'm just going to mark the price of Series A per share to whatever Series B per share was worth. So this approach is not working pretty well in most cases. The second approach is value the contracts as written. So you take the contract, you read it carefully, you build a contingent claims approach, and then you try to basically understand the contract, which is non-trivial, and try to take into account all those fancy contractual terms. Andrew Metrick and Metrick Yasuda started this back in 2010, and then Will and I picked it up and developed this into a framework and applied this to unicorns, to 135 years unicorns. So unicorns are companies that have a reported value of over $1 billion. And this is the visualization that obviously neither Will nor I could do pretty well. That was in the Fortune magazine, which basically shows that if you look at the left, there's a fair value at the bottom, which shows basically that every single unicorn in that data set is overvalued. Some are dramatically so. SpaceX is somewhere in the middle, overvalued by 65% because of all those contractual terms. Now, this is the approach that we're going to use in this project, in this new project. However, this specific approach that Will and I used also has an important challenge. And an important challenge is that every single round, the terms are renegotiated, so that Series B entering will be renegotiating terms. But even more importantly, when SpaceX is going to issue Series C and then Series D, then the terms of the previous rounds are also going to be renegotiated. And specifically, many of those terms of the existing securities could be impaired in future rounds. So here is an example that is kind of right coming out of the MBA class that we teach. So everybody knows this gentleman. And I'm sure that you watch Silicon Valley. So when Facebook was founded in 2005 or 2004, very soon after that, Mark Zuckerberg and his co-founders got fallen out. And here's a quote that was quoted in a lawsuit. So Mark Zuckerberg emailed to his lawyer about reducing co-founders Eduardo Severin's ownership. So this is the email I'm going to quote. Is there a way to do this without making it painfully apparent to him meaning Eduardo, that he's being diluted to 10%? So this is an example where there's going to be the next round, and some common shareholders' stake is going to be diluted from a much larger number to 10%. So this happening not only with co-founders that got fallen out, but also to earlier investors. So this is the major challenge. That this is also one of the reasons why in the unicorn paper we actually chose unicorns, because they're late stage companies and they're less likely to issue further rounds that will substantially impair existing rounds. So let me show you how it works. Let me go back to SpaceX and I will show you what's happening with the Series B. So this is going to be the payoffs only and only of Series B, but after various rounds issued. By the way, SpaceX issued all until L and is raising right now another round, and every single letter until L has been filled. So I'm going to show you some. So this is the payoff of Series B after Series B, when it was the most recent security issued. That will happen to its payoff after Series C. This is after Series D, after Series E, and after Series F. And so what's basically happening, especially as you see after Series F, just to ensure that basically Series B will not get anything, even if SpaceX would be successfully sold for $500 million. So this suggests that the value of Series B was substantially impaired, well, a little bit impaired kind of by Series C, by Series D, by Series E, and then dramatically impaired by Series F. Now, the point, of course, that at the time of valuing, at the time of Series B, you need to take this into account. And that is not what previous models, including the model that we did, developed several years ago, did. And so that is a challenge. And that is the challenge that we're going to do. Future rounds are also on the mind of decision makers in the industry. First of all, whenever I talk to MBA students at Stanford who would like to be startup founders, there are two words that scare them most of all. The first word is founder unfriendly. So basically, they divide the world of terms, of all the contractual terms that VCs can offer them, into either founder unfriendly or founder friendly. And they always prefer, of course, founder friendly terms, as the name suggests. And second is that they all dread dilution. So that's kind of going back to Mark Zuckerberg's example. That's what he did to his co-founder. They typically dread different type of dilution. Dilution, well, similar, but not when co-founder dilutes you, but when preferred investors, VCs, dilute you as more rounds come in. And so that's two words that I hear most often. Investors are also concerned greatly about the dilution. In fact, of all the venture capital terms, from the investor's point of view, there is one term that they never would negotiate on. So Steve Kaplan, Paul Gompers, Will and I did a survey paper of 1,000+ investors a couple of years ago, and we asked them what kind of venture capital terms you're willing to negotiate on. And they were willing to negotiate almost on everything, apart from prorata. Prorata gives you the right to participate in the future rounds and prevent being diluted. And whenever I have panels of venture capitalists in my MBA class, they always say that most important for them is to keep their stake. And so whenever there is the next round and they think the company is doing well, they will always try to prevent dilution. And so this is one of their major concerns. And so what we're going to do in this paper is we're going to study the impact of future rounds on today's asset values. And it is a non-trivial task. First is because future financing can both impede the value of current investors and increase the value. It can impede because there could be terms that basically, like in SpaceX example, make existing investors more junior because new investors will be senior, will get better terms such as liquidation preference and so on. Future financing can also increase the value of current investors. For example, equity injection in the future effectively will increase the value of debt-like downside protection. And there are additional terms such as anti-dilution terms that will increase the value of existing investors. So again, it is not obvious what is going to happen, what is going to be the impact of future financing. So what we are doing in this project, and after this slide I will stop and I will ask the moderators if there are any questions I can answer at this point. So the goal of this project, we started this project with a very simple goal. We tried to build a valuation model that takes proper care of future rounds, because we believe that future rounds are important, prevalent in this industry, and the truth is, didn't really know how to approach that or what the impact was. Since then, as I'm going to try to show you, the goal shifted a little bit, and the reason is that we identified some very interesting economic results. The key assumption that is going to be held throughout the paper and throughout my presentation as well, we're going to assume that future rounds are competitive. There are sophisticated investors that compete for all the future rounds, and we're going to assume that those rounds are fairly priced, so that if they're too low, too high, there will be negotiations between existing investors, between new investors, coming investors, and so the future rounds are going to be fairly priced. And the key questions we're going to ask are the following. So the first question is, how important are future rounds for valuation? The second question is, are the founders' worries about the founder unfriendly terms justified? Are there value transfers between the existing investors, as the SpaceX graph kind of suggests? And the question that was kind of hanging over us from our original paper is, over valuation that we found, generic to unicorns, sorry, generic to the industry, or confined just to unicorns? Andrei, maybe let me stop here and ask you whether there are any questions.
All right, thank you, Ilya. So do anti-dilution provisions also put restrictions on maintaining seniority?
So there is a non-trivial relationship between various contractual terms. And anti-dilution provision, typically as they're written, they don't put any constraints on anything. They basically, effectively, in its simplest form, even though infrequent, called full ratchet. Effectively, the existing venture capitalists will be able to keep their entire stake in the case of a down round. Their seniority is not going to be affected directly. However, the incoming investor may demand a seniority. So, for example, we sometimes observe that there's going to be anti-dilution triggered, and at the same time, the new investor will be senior. But the point to remember is that it is all up in the air, because it's all up to the negotiations between the existing and the future investors. For example, very often observe that anti-dilution is there, but is not triggered. And the new investors may or may not have seniority. So, well, everything is possible. Any other questions, Andrei?
No questions at this moment, but I'm sure they're coming soon.
Absolutely, thank you. So, so the second block of my presentation is about our model, and this is going to be as non-technical as possible, because otherwise I think we will get bogged down for the rest of the presentation. But let me start with the modeling challenges. We spent really, I think, more than 2 years just thinking about how to do it properly. This is non-trivial, and the reason is that, of course, pricing of each round is going to impact the pricing of all the other rounds. As my answer to the previous question suggests, there is just innumerable variety of potential term combinations, and Will and I are now studying the contracts, hundreds, thousands of these contracts, and there's truly every single contract is unique. The term combinations also interact, as I already mentioned, in non-linear ways. So going back to the previous question, it was about anti-dilution seniority. So anti-dilution is also related to the liquidation preferences, a high future liquidation multiples specifically. And so this all means that it kind of solving a very high dimensional fixed point problem that we've basically spent 2 years to solve. So here's basically how the model works in a very non-technical way. So we're going to start today with a situation such as, for example, SpaceX Series B. We're going to assume that we know the initial financial structure, which means Series B, Series A, all the terms of Series A and Series B, which is a reasonable assumption because very often we observe the contracts, and even if we don't observe the complete contracts, we kind of know quite a lot about the financial structure. And then in the future, we're going to exit at some stochastic time and stochastic value, according to how the values in the model are going to develop. Or, and that basically actually summarizes our original paper with Will. Or there could, okay, I went too fast, I'm sorry. We proceed with the next round of investment. And then the investment will happen at stochastic time. And if it happens, then the terms are going to be also stochastic. So they are going to be determined by what we know empirically about the terms as a function of the existing financial structure and as a function of the value at the time of the new fundraising. And then this continues, and potentially it continues forever. So after every single round, there will be either exit at some random time and random value, or it's going to be the next round. And again, so this model nests our model with Will, it nests other contingent claims frameworks, and it nests empirical cases of Uber and Facebook raising 10 plus rounds. It also raises companies that just raise one round and then fail or exit right away. The firm value is going to follow the geometric Brownian motion, not surprisingly. And what's going to happen is that at a random Poisson time, there's going to be either exit with a certain lambda parameter, or there's going to be an investment with a different parameter, happening with a different random parameter. And when the investment happens, then the fundamental firm value goes up by the value of the investment. Remember that we assume that each round is fairly priced. So therefore, basically, the value of the company must go up by the total amount of investment that comes into the company at this point. So in this case, 3 million was invested by the new investors in this round, and the company jumped by 3 million. And then later on, at some random time, the company exited at $15 million. And again, it did not need to exit. It could have had another investment at this time and then exited at a later point. So in the model, we are going to take care of the investor payoffs and basically most important contractual terms. So let me preface by mentioning caveat. We cannot hope to take into account every single contractual term. So with unicorns, we actually read very carefully every single contract and we take into account virtually every single term. Here we're going to deal with thousands and thousands of rounds, and we're going to take care of most frequent terms from experience, but likely we're going to miss some of the more unusual terms. Most important type of security in VC contracts is convertible preferred stock. And let me just very briefly, for those of you who may not know what this is, mention what convertible preferred is. It consists of basically two terms. Preferred stands for liquidation preference, and this is basically a debt-like component. It means that there's seniority of common shares, and it is L times over the original investment. So L most of the time is 1. That means that if I invest $100, I'm senior $100. Until I get $100 back, common shares will not get anything. But it also could be 2, 3, 4, 12 times. We see in our data, meaning that if I invested $100, until I get 1,200 in that case, common shareholders will not get anything. In addition, when there is a lot of classes of convertible preferred stock, such as in SpaceX, A, B, C, D, L, then there will be a very carefully designed ranking of seniorities. And it could come in all sorts of ways. It could be pari passu, where everybody is equal, or it could be waterfall provisions, where one class is senior to another class. And so there's going to be a number of waterfalls, which is until class C or Series C gets everything. Series B will not get anything, and then Series A and so on. The convertible stands for conversion, which is at each point in time, this stock could get converted into common shares at the pre-specified conversion price. That also might change. So the question about anti-dilution was really about the question about the conversion price. The conversion price gets adjusted in the case anti-dilution is triggered. And so this basically gives venture capitalists some protection in the bad states of the world and gets them the ability to participate in the upside. I'm going to skip a lot of other terms here in this discussion, even though we are going to take this into account. We're already describing these terms in our unicorn paper, so you might go back and look at the terms we're also taking into account here. And finally, let me introduce the concept of post-money valuation, or PMV, which is what the industry uses. And so this is what the industry reports, or what all the companies report in the industry. And this is very simple. It's just price per share of the most recently issued round times the total number of shares on the fully diluted basis. So what the fully diluted basis is that we take the total number of shares, common shares that are outstanding, as well as all those common shares that could result from all possible conversions. For example, take all the preferred stock and convert them. And take all the other stuff, for example, employee stock options, and also convert them. So that's going to be the fully diluted basis. Now, if we value the publicly traded companies such as IBM, the post-money valuation is based like market cap. But it is not the case here, because obviously, as I already mentioned in SpaceX, Series A is not equal to Series B. Common shares is not equal to Series B. And therefore, when you multiply price per share of Series B times the total number of all shares outstanding or that could be converted, you're getting PMV, which is not a fair market value. So here is how the model works. And I apologize, I thought about many different ways to show this without equations, but it's very difficult. So, but I hope it's pretty intuitive. So what's happening here, P capital is the post-money value. I is the investment, I capital is the investment, and I small, I subscript is the round, the round number. So when you divide I capital by P capital, that is basically the ownership fraction of the new incoming investors on the fully diluted basis. And what's happening here, and this is small o, this is basically the dilution. So that with every single round happening, all the investors get diluted. So this shows the dilution of an I round, of I type of investors, but also you can do the same, of course, for every single I. So basically, as more and more rounds get issued, like A, B, C, D, L, and so on the fully diluted basis, you as an investor in this round own less and less of the company, and this is what's taken care of. Let me also mention that the payoffs in this industry depend a lot on the outcome, which is kind of unusual, I think, for other financial markets. Specifically, payoffs are going to be different in the IPO and in the M&A. In the IPO, typically, or not typically, in the IPO, always, the conversion happens. So basically, all the shares get converted, and therefore, what you get, so pi here is the payoff of security I, and X is going to be the fundamental value of the company at that point. This is the geometric Brownian motion with the jump, pause, and jump process. T capital is the time at which the company exited. And so what you get in the IPO is simply whatever the fundamental value times whatever your ownership of the company at the time on the fully diluted basis. So that's straightforward. The M&A is much less straightforward and much more complicated. And basically, in the M&A payoff, typically you as an investor don't need to convert, but you can convert. And so you kind of decide whether you would like to convert and get a common share payoff, or you get the liquidation payoff, which is a liquidation preference payoff. And it also depends on who is getting converted and what specific contractual terms you have. Let me not go into these details right now. It's actually not really material, apart from complicating dramatically the solution of the problem. But for those of you who are into this field and know pretty well how this works, I just would like to mention that we do take care of all the possible scenarios here virtually, including, most importantly, the participation scenario. Maybe, Andrew, let me stop here and ask if there are any questions.
All right, questions. So contracts are probably determined by the bargaining power of various parties at each issue. What is likely to drive each party's power? I presume that is your focus in this model.
So that's a very good point. So we're not going to model bargaining explicitly. That is not our goal. We're going to take it in a reduced form way, but absolutely. So for example, when the company is not doing well, and in our case, when X at the time of the financing round is going to be quite low, then the incoming investors are more likely than not to have a high bargaining power, and therefore they are more likely to get provisions such as seniority over the existing investors, or participation, or some additional terms that we're going to model as well. So basically, we're going to use a reduced form. We're going to see empirically, just because we have tens of thousands of rounds, for example, when is the probability of new investors getting seniority over existing investors is higher. And that's going to be more likely in the down round scenarios where the bargaining power of the existing investors is lower. And based on this, we're going to incorporate this the outcome of the bargaining in our model.
Okay, not every investor in the market values the security in each round in the same way. So they are not always making early rounds to the latest round value. marking earlier rounds to the latest round value. Could it be possible that they account for future rounds?
If I understood the question correctly, you didn't come very clearly. Sorry, Andrei. Is that different investors mark their securities differently to, even though they participate in the same round? That is the case. We know about this. I don't think that's because they take any explicit care of the future rounds. I think that they just use different approaches. So most of them use approach number one, which is they're going to use the most recent round, but some of them don't. Some of them, for example, just don't change the values at all. Some of them, for example, some LPs, limited partners, investors in venture capital funds, told me, oh, we're going to take into account for what we think intuitively whether venture capital funds are aggressive or not aggressive. So if we think they're aggressive, we're not going to mark to the most recent round. And if we think they're conservative, we're going to mark to the next round, and so on. So there could be many explanations of the way investors mark. I think that one outcome, from my point of view, is that we can't really look at their markings and think of this as a fair value. So we need to look at how much investors actually paid and what the contractual terms they received.
Okay, when you discuss dilution, it seems that you mean dilution of control rights only, but not necessarily cash flow rights. If the price per new ownership shares is priced fairly, the cash flow rights will not be affected. Is this correct?
So, okay, there are 2 points here. First, in fact, it is the opposite. And I'm sorry if I haven't clarified this. So when I say dilution, I mean dilution of cash flow rights, meaning that as in Mark Zuckerberg's example, the co-founder owned way more than 10% of Facebook, and then his share was diluted, his stake, and he owned 10% or less of Facebook. We in fact do not here, we abstract here from control rights. So that's obviously a caveat to what we do here. And the second point is that, well, at the point of funding, obviously we do take into account the dilution. But the previous models do not take into account about the possibility of the future dilution, because obviously nobody modeled future rounds. Now, investors should think about the future dilution. In fact, they do. So we know this. When we talk to investors, they think they do care a lot about that new investors will come in and dilute them into the future, and therefore the price today should take care of this, should take this into account. And that's exactly what we're trying to achieve. Andrei, if you don't mind, let me continue. I would like
just one more question, if I may. So you have mentioned that you take the initial financial structure as given, and then you see how the subsequent rounds are being structured. Can you speak as to what could be the optimal initial financial structure of such ventures?
I'll be happy to discuss this question after the presentation, because we take the financial structure as given. We do not attempt in this specific model to identify the optimal capital structure, but I'll be happy to discuss this later.
All right.
So let me move on. And so basically, this is the benchmark equation, which is very simple to write and very difficult to solve. So this basically one equation is about 2 years of work that will end up likely in footnotes and appendices to the paper. So what's shown here is V. V is the fair fundamental value of each security I, which is a function of the fundamental value of the firm X, the time T, and what I haven't mentioned so far is Z. Now Z, capital, is the contractual terms. This is basically everything that can be described as contractual terms of the round J. And so the value of security I is going to be a function of all the contractual terms of all the securities that are outstanding up to this point. And it's equal to the expected value, the present value of the payoffs, but the payoff is going to depend on the fundamental value at the exit time, notice T capital. And notice now that Z, you see also ZJ, but now it's contractual terms of all securities that could be issued up until that exit time, which obviously includes securities that have not yet been issued. And so going back to one of the questions that that one of you asked, it will take into account the anti-dilution that might happen, sorry, not anti, the dilution, well, as well as anti-dilution, that might happen in the future between time T small today and time T capital in the future when the company finally exits. So that is the whole idea of this paper. And we basically solved it in a parsimonious way, I believe, that takes care of all the considerations that I mentioned. And what is going to be important for the economics, and bear with me, that is, I believe, the last equation that I'm going to show you today, is that it is possible to decompose this value into two big components. And if you remember the figure I showed you about the evolution of firm value, after each round we either exit or we raise another round. And this is the way we can decompose the value, which is the value which security at any time equals to the first component, which is the value of the security if the firm is going to exit without raising another round, plus the second component if the firm is going to exit plus the second component, which is the value if the firm is going to raise another round before exiting. Now, if we remove the second line here, if we remove the second component, then in fact we're going to go back to the original paper, the original model that Will and I wrote, and through that to the original idea of Andrew, Metrick, and Yasuda. And the second component, that is going to be the component that we're going to incorporate in this model. So let me show you the results of the model solution. So first of all, let me briefly introduce the data. We use PitchBook data and Genesis data. I don't have time to talk about what this actually are and why we decided to combine them. Obviously, each of them has pluses and minuses. We use most US venture capital rounds from this period, 2003 to 2019. It's about 19,500 companies and 42,500 venture capital rounds. First of all, we do see a very significant contractual variation. Just a couple of examples. About a third of the contracts are senior, meaning that preferred securities are senior to other preferred securities. About a third are participating. Participation means a contractual term in which the convertible preferred securities are double dipping, meaning that they have the right both to liquidation preference and to conversion. Something that founders find particularly founder unfriendly. And about 7% have liquidation multiples greater than 1. So let me show you how the value transfer happens. This is going to be a numerical example. And then I will show you how the transfer happens in our data on 42,000 rounds in the data. So what do we mean by value transfer? Is the following: is that what's showing here again is the exit value and the X and per share payoff. And this is an example of before Series B issued. And the blue here is basically the common stock, and the red is the value added by the special guarantees that Series A get. So this is basically the contractual terms of Series A. And now Series B will get issued. And what turns out to be that the value could be transferred either to Series A or from Series A. So let's have a look. In the first case, let's say we issue Series B using common equity, which is not very frequent, but for example, Snap used that procedure. So they issued one of the series preferred stock as a common equity. In this case, there's going to be a value transfer from series from common to Series A, or, which is more common potentially, we're going to have Series B will be senior to Series A and also 2x liquidation multiple, which means that for each dollar of investment, Series B will be entitled or guaranteed of $2 on the eventual exit. In this case, there will be a value transfer, as you see here, from Series A to common. Just to ensure that everybody is with me, let me recall that there's no value transfer from Series B to anything at this point. That is because Series B is a new investor coming in and is a fair value. So Series B issued at the investment I. And so there could be value transfers from existing investors to existing common shareholders, basically from investors to founders, or from founders to investors. And this all depends on the outcome of the bargaining of how Series B is going to be issued. So that is what we're going to explore. And let me finally show the data. So this is, let me show exactly what I'm going to have here. This is going to be change in the share value for each dollar per share invested. And the reason we're showing you this measure is because obviously some rounds are very small, some companies are very small, so some are very large. So we really would like to be able to compare small companies with large companies and small rounds with large rounds. And 0 meaning there is no value transfer at all. And then plus meaning that that specific class is going to improve in value as a result of the round. And minus means is going to be the value transfer away from that class. And I'm going to show you for 3 different sets of securities. The common shareholders, which most of the time are founders and employees. The most recent preferred, for example, let's say we had A, B, C, and we're just raising Series C round. The most recent preferred is Series B. In SpaceX, that is raising now, or will be raising soon, Series L, this will be Series K. And other preferred going to be all the other investors, apart from the most recent issued. So let me show you the result. This is the value transfer of the most recent preferred. And the first thing that you note is that it is very, very asymmetric, and that it could go both ways, but that in fact, more likely than not, there will be value transfer away from the most recent preferred to others. What others? This is the other investors. And again, what we see here is that it could go either way. It concentrates around 0. So in fact, in most cases, the value transfer is very small. Or the future rounds basically don't matter. But sometimes it could be non-trivial. But if they are non-trivial, it's the transfer away from the preferred. Who is the beneficiary of that value transfer is the common. So this is perhaps one of the first very surprising results. And Will and I spent really a lot of time, both on the data and on the economics around this. That's because we didn't expect that. That is because also it goes in the face of all the intuitive evidence of what we see, what we hear in the industry. Because the industry thinks that it is the founders, the common shareholders, that are always getting beaten up or beaten down by every next round. So what we see here is that to the extent that value transfer is happening at all, and sometimes it does, typically the value transfer is away from preferred investors and to the common shareholders. So the common shareholders, in fact, are benefiting from the future rounds. So that is a very interesting, I think, result. And the second result, which is very much related, is that founder-friendly terms, and I'm going to put them in quotation marks, actually do hurt founders. So that is the result that I haven't mentioned to my friends who are founders, but I'm very curious to know what people think about this. So again, the caveat is that future rounds are fairly priced. What we found is that founder-friendly terms transfer value from founders to existing investors. For example, let's say terms that no participation, low liquidation multiples, and so on, that are cheered by all the founders, and founders try to bargain hard all those terms. Actually, they are founder friendly, actually they are founder founder unfriendly, counterintuitively. And the terms that are investor friendly or founder unfriendly, they actually transfer value to founders. So it's exactly really the opposite of what people would expect. So what is happening here? I think what's happening here is that there's a misunderstanding on the part of founders and investors, and it also took time for Will and I to fully appreciate this intuition as well, is that investors typically have a debt-like claim. When I say typically, almost always, a debt-like claim because of the liquidation preference. And what's really happening is that the most important input of the future debt-like issuance is to reduce the current debt value. And this is similar to the debt dilution that people have been talking a lot these days in other contexts. And what this really means, and again, if the future rounds are fairly priced, this would imply that the terms that are particularly founder friendly, considered to be founder friendly by the industry, they're in fact those that are less debt-like, and therefore they're less impactful to the existing preferred investors, and therefore they're more likely to transfer value from the founders, from the common shareholders, to all the existing investors. So I think this is a very interesting finding. The reality why the industry, I don't think, has appreciated that up to date is likely because the terms that are founder unfriendly or founder friendly are more likely to happen in bad or good states of the world. And the fact that the future rounds are still could be fairly priced, even though the state of the world could be fantastic, it could be bad, sometimes is kind of hidden from the view of the founders. The second major finding, I think, of this project is that under many realistic assumptions, when I say realistic, meaning empirical assumptions based on all the data we have, as a composite, future rounds have relatively little impact on valuation. And so we started this project by saying, gosh, our unicorn paper model is not really applicable to early stage companies. It turns out to be that actually it's not that bad, is that on average, the future rounds will have relatively little impact, even though of course there are some exceptions. So in this graph, the solid black line is no future rounds, which is the impact of the future rounds, and which shows just the difference between Series A and common share values as an example. So the specific number on the y-axis is not really important. But what you see in the dotted blue, which is very, very close to the black, this is what happens if you take into account all the future rounds according to our fully developed model, if the future is just standard convertible preferred stock. And as you see, there's almost no difference. Obviously, if there's going to be, if we choose on purpose very much investor friendly or very much founder friendly terms, and again in quotation marks, then the difference is going to be substantial. I think the most useful one is simulated. So one of the questions that one of you asked me earlier is about the bargaining. And so in simulation, we kind of use the reduced form of the bargaining outcomes. And so those what we think are realistic scenarios of how, given what we know today about the companies, what we can expect on an expectation, the future financial structure to look like up until the exit. And so the most important comparison here is between the solid black line and the green line, and they're relatively close. So that's basically the difference, that the model that takes full care of future rounds adds. And it does add something, but not as much as we initially expected. And so that's kind of just another way to look at it. Here we have the overvaluation that I'm going to mention in more detail in a second, with and without future rounds. And so what we see here is that overvaluation, the solid black line is the diagonal, and there is the fitted value, or the from the model, is very similar from the actual overvaluation that we observe in the financing rounds. So basically, the model with future rounds is actually doing a pretty good job, with some notable exceptions. Maybe let me stop here and take further questions, Andre, if there are any.
So Ilya, I have to say, Will has been stealing all the work from you because you've been answering questions all the time. I think there's probably only 1 or 2 questions unanswered so far. So is this common result, I'm talking about the founder-friendly terms actually harm them? Is this common result because founder-friendly terms result in very low post dollars? Is for example, substitutability of contract terms? I'm not sure whether the question is, sufficiently clear.
No, it is not clear to me, I have to admit. So,
So I'll then ask
I'll be happy to answer the rephrasing of this question later on.
Okay. Would it be plausible that the exit decision is based on the number of rounds following the investor's investment? Does the model take that into account?
Can you repeat the question, please?
Would it be plausible that the exit decision is based on the number of rounds following the investors? I think that's...
Oh, I see. Right. So the question is whether the exit is a function of the number of rounds. Potentially, even though we don't take this directly into consideration. But in fact, we did, and also other people, so Arthur Korteweg did some work on this, about the distribution of returns, and also about the timing of rounds. And they actually fit pretty well into the modeling assumptions that we use. And thank you, Will, for taking care of all the questions. Let me show you finally the result that is very new. That the caveat here is that I'm pretty confident in everything I showed you so far. So here I'm going just to speculate a little bit because Will and I are still working on this, but I thought it is so interesting that I'm going to show you this now. So hopefully to generate some discussion and thinking. So here what I'm going to show you is the following. On the X is going to be the model price, and on the left is going to be some empirically observed prices. Now, what do you mean by empirically observed prices? There are actually 2 sources. The first one is that there's a growing secondary market. It is still very illiquid, but there are some platforms that exist, and you can go there and buy the shares, common, preferred, of companies that are still venture capital backed, that are still private, such as SpaceX. So what we did is that we took some examples from those platforms, and I'm going to show you the actual transactions. So those are going to be the prices for actual transactions. I'm not going to reveal the specific companies that we used, and you will see that there are not so many transactions yet. This is the black line is just the diagonal, 45-degree line. And this is the prices. And the red dotted line is the fitted line. And again, this is what our model predicts, and this is the actually observed transaction. And what you see here is, well, a pretty good fit, I'd say. So basically what we see here is that our model actually can predict pretty well the observed price. Now, there are 2 caveats here. One caveat is that obviously we have to be very careful. There are not so many observations. Actually, there are very few observations. And so obviously the results could worsen dramatically. The second caveat, in fact, is would suggest that the model should not perform that well. And the second caveat is that, again, this is a very illiquid market, and the and the funding rounds happen about every 15 months or so. And typically we observe secondary market prices well after the previous round. So here we did not take all the transactions. We took only the transactions that are within the 6-month period. So if the round happened, let's say, on the 1st of January, of that year. We took only the secondary market prices that took place between the 1st of January of that year and the 1st of July. And obviously that why it also constrains the number of observations. So sometimes there's actually could be a non-trivial gap between the date of the funding round, on which we base, of course, all the model assumptions and parameters and so on, and the actual date. Nevertheless, what this suggests, and obviously Will and I are going to explore this much further, and hoping to get much more data, much better data on the actual transactions. What this suggests is that model potentially can price the secondary market transactions pretty well, and also can be used by market participants in an attempt to see whether the transaction that is offered to them is at a fair price. The second, what I'm going to show you, the second type of empirical observed prices, a very different type of an animal. What I didn't mention so far is that for tax purposes, these companies, the VC-backed companies, must annually do what is called 409A valuation. And what 409A valuation is effectively, it's typically done because they have to issue options to their employees in the employee stock option pool, and those options must have option prices, the strike prices, and the tax is going to be a function of the strike price. And effectively, the companies used to do it themselves, and about 12-13 years ago, they were prevented from doing so, and they had to hire an independent assessor that is doing the 409A valuation. Now, as you can guess, because the tax is paid off the strike price, the idea is to lower the strike price, and the way to lower the strike price is to lower the price, or vice versa. But anyway, what we have here is that each gray dot is the observation of a 409A price, and for a particular security, and on the X again is our model price. And what we see here is that the tax price is dramatically lower than the observed price. Like we have an observation with, let's say, $11-12 that we predict that the security is fairly worth, and the tax price on 409A valuation reported as the fair price is going to be $4. And again, it is advantageous for companies to do so, but this suggests that the 409A valuation is absolutely not fair value. So let me show you actually fun quotes that Will and I found. So those are two companies that provide 409A valuations, and I'm sure that you will love them. So the one is ShareWorks, owned by Morgan Stanley, and I'm going to quote you from the advertising materials, and emphasis here in bold is going to be in the original. The strike price must never be below the current value of your common stock, okay? But there are still ways to legally lower your strike price by getting the valuation of your common stock down. And as we see, they're pretty good at what they say. They definitely reduce it by factor of 2 or 3. Here's another example, MELD valuation. And again, the emphasis in the original. At any one point in time, a company can have a value spectrum depending on motivations. Somebody asked me about optimal contracting before. I love the word motivations in this context. So at any one point in time, a company can have a value spectrum depending on motivations, purpose of the valuation, information asymmetry, etc. What we aim for in 409A is to try and get you the lowest possible answer that is still defensible against an audit. What they mean is a tax audit by the IRS. So what our data suggests so far is that they're pretty good at what they say. Is that they do lower the strike price or the price of the common share quite a bit. Again, the caveat for the previous slide is that this work is really ongoing. We don't have sufficient number of data points either for the secondary market transactions or for the 409A valuations. So these are very preliminary results, but I actually think they're pretty interesting and pretty exciting. And moreover, I think they're pretty important, consequential for the investors and for the industry. And
Ilya,
finally,
Ilya, let me try to beat Will to one of the questions because he's
absolutely,
answering them much
absolutely.
faster than I'm able to read. Shouldn't the secondary market prices have some liquidity discount embedded in them?
That's a good question. So potentially yes. Of course, that depends on the nature of the participants. So who is selling and who is buying, potentially. In our case, in our model, we do not have an explicit liquidity discount. That is a good question.
All right, thank you.
So let me show you the final slide. Really, is that when we started this paper, we did not think about that. You know, we would go into 49As and secondary markets. We would not think we would uncover some interesting economic mechanisms about value transfers. Our original goal was basically try to see the impact of future rounds and try to see whether overvaluation is generic. And so we found two interesting results. The first one, and this shown in the upper part of the slide. There's two rows of the table. So we have the unicorn in our unicorn paper, valuation was about 48%. And overvaluation is basically the ratio of the post-money reported value to the fair value as implied by the model. And the current sample we have, as I mentioned, 42,500 observations. And we found there is still a very substantial overvaluation of about 36%. Now, it's a little bit lower than the unicorn paper, but one caveat here is that in unicorn paper, we actually went and read line by line every single contract of those unicorns. And some of those unicorns had really, I would say, bizarre terms that increased overvaluation dramatically. In the current sample, we haven't done so, even though we actually are doing so as we speak, but not for all 42,000 companies. But we haven't done so, and so some of the most bizarre terms that potentially have a large impact on the overvaluation may have missed. So I would say this is a conservative estimate. So that is the first result. The second result that we find interesting is because we have so many observations, we plot the average overvaluation in our large sample as the time trend from 2009 to 2019, kind of year by year. And what you see is that the average overvaluation did come down from way above 30% to about 20% as of 2019. And there are several explanations which we haven't yet looked at carefully. But one explanation is that over time, the contractual terms change, and specifically they get simplified, especially in the early rounds. And that might result in the lower overvaluation. And again, lower overvaluation means that the reported value, the post-money value, is kind of closer to the fair value. So this is the current state of what we've done. And again, let me repeat that it is a very, very early work. That is the first time we've been presenting it. So therefore, I really hope to get comments and more questions. So let me conclude very quickly, is that what we've done is we built a valuation model that takes into account dynamics and complexity of contractual terms. And we found several unexpected results. We found that founder-friendly terms are not what they seem. And I really look forward to presenting this to the founders and the investor community. We need to find a way to do so without showing any equations. We also found that the overvaluation is prevalent, that future rounds don't matter that much for the valuation. And a very, very preliminary finding is that the model values seem to fit well secondary market prices, but not 498s. So let me stop here and thank everybody for attention. And again, I'm going to stick around after the seminar if the technology is going to work, and I'll be happy to answer, and Will is going to also be happy to answer way more questions.